Exploding debt, a major crisis. These aren't just buzzwords, they're a real worry for anyone with a stake in the global economy. For nearly a century, one thing has been as good as gold: American debt. But what if the unthinkable happened? What if the world suddenly decided it didn't want it anymore? The United States currently owes over $36 trillion. That number is so large it's almost impossible to comprehend. It's more than the combined economies of Europe, Africa, and South America. For decades, this mountain of debt wasn't just manageable, it was the very foundation of global finance. Friends and rivals alike, from Japan to China, bought U.S. Treasury bonds, using them to secure their pension funds, their national savings, and even their own currencies. The entire system was built on one single, unwavering assumption: the U.S. dollar would never fail. But that assumption is now facing its greatest test. Since 2008, U.S. debt has more than tripled. The cost to simply service this debt, not pay it down, just pay the interest, is projected to be around $1 trillion this year alone. And with every new budget, the pile grows higher. For the first time in generations, a dangerous question is being whispered in the halls of power and on trading floors around the world. Can America actually afford all of this? And it seems some are already making their decision. Since 2021, major players have been quietly backing away. China, once the largest foreign holder of American debt, has seen its holdings decline significantly from its peak. Japan, while still the top holder, has also sold off hundreds of billions worth of bonds in recent years. Even America's closest allies are getting nervous. If this trend continues, if the world's confidence in the U.S. economy truly breaks, it won't just be an American problem. It could bring the entire global economy to its knees. Today, we're asking, what will really happen if everyone stops buying U.S. debt? The consequences are more far-reaching and frightening than you might imagine. What will happen if everyone stops buying us debt? The Bank of the World. To understand where we're going, we first need to understand how we got here. How did U.S. debt become the bedrock of the world's financial system? For nearly the last 100 years, the United States has effectively been the bank of the world. After the devastation of 2 world wars, America stood as the undisputed economic powerhouse. Its factories were intact, its economy was booming, and its political system was stable. When the U.S. government needed to borrow money, it issued something called a treasury security, a bond, a note, or a bill. Think of it as an IOU. You give the government money, and they promise to pay you back with interest. And for decades, almost every major country queued up to buy these IOUs. Japan, China, the United Kingdom, and many others hold hundreds of billions, and in Japan's case, over $1 trillion of U.S. debt. For them, it was the ultimate safe investment. You see, a company, even a massive one, can go bankrupt. But a country, especially the world's leading superpower, that seemed impossible. Pension funds, sovereign wealth funds, and central banks, all managing money they absolutely cannot afford to lose, saw U.S. debt as the safest place on earth to park their cash. They might only get a 2% return, far less than the stock market, but it was guaranteed, or so they thought. This created a powerful, mutually beneficial relationship. Foreign countries got a safe place to store their wealth, and the U.S. got access to a seemingly endless supply of cheap credit to fund its growth, its government programs, and its military. There's an old saying, if you owe the bank $100, that's your problem. If you owe the bank $1 million, that's the bank's problem. Well, with a debt of $36 trillion, the U.S. has made its debt everyone's problem. And that problem began to spiral in 2008. The debt spiral begins. The 2008 financial crisis was a seismic shock to the global system. As banks teetered on the brink of collapse, the U.S. government did what it had always done in a crisis. It spent its way out. First came the Emergency Economic Stabilization Act, $700 billion to bail out the failing banks. Then, the American Recovery and Reinvestment Act, another $831 billion for tax cuts, infrastructure, and direct relief. These measures helped prevent a full-blown depression, but they came at a staggering cost. All of it slapped on the national credit card. From 2008 to 2020, the country's debt exploded. But here's the crucial part. For most of that time, it didn't seem to matter. This was the era of free money. Interest rates were near zero. Because everyone still saw the U.S. as a financial safe haven, they kept buying its debt, which drove the interest rates the U.S. had to pay to historic lows. So even while piling on trillions in new debt, the cost of borrowing was practically nothing. It was a manageable burden. Of course, this strategy had a hidden danger. A rise in interest rates of just 1% would cost the government hundreds of billions more each year. And an even bigger danger loomed. What if foreigners suddenly lost confidence and started dumping that debt? It could trigger a catastrophic sell-off, crashing the dollar and unleashing an inflationary crisis. But in the early months of 2020, few saw that coming. The US economy seemed to be in good shape. Unfortunately, a once-in-a-century crisis was about to derail everything. When the COVID-19 pandemic hit, the government knew it had only one tool to prevent a total economic collapse: massive, unprecedented spending. And that's exactly what they did. Trillions of dollars were pumped into the economy in record time. Stimulus checks, business bailouts, enhanced unemployment benefits. By the time the dust began to settle, the US national debt had surged by more than $5 trillion. That's an extra $15,000 of debt for every single person in the country, added in just a few short years. After the pandemic, America's debt stood at over $31 trillion. For the first time since World War II, the country owed more than 100% of its entire annual economic output, or GDP. What was once a manageable burden was now a ticking time bomb. And remember that core assumption that the US dollar was rock solid? With this colossal mountain of debt, investors around the world started to seriously question if America could ever truly pay it back. The whispers grew louder. The foundation of trust began to crack. The great unwinding. This is the part of the story where things get real. The theoretical risk of a sell-off is now becoming a reality. Let's look at the numbers. China's holdings of US debt peaked at over $1.3 trillion in 2013. As of April 2025, that number has fallen to around $757 billion. That is a massive reduction, a clear and deliberate strategy to diversify away from the dollar. Next is Japan. While still the largest foreign creditor with over $1.1 trillion in holdings, they've also been trimming their position, selling off significant amounts over the last few years. And it's not just rivals. In a surprising turn, the United Kingdom recently overtook China as the second largest holder of US debt. But analysts suggest this might be misleading, as London's role as a global financial hub means many international investors buy treasuries through UK-based institutions. Even so, the trend among many long-standing allies has been to reduce their direct exposure. So why is this happening? It's a loss of confidence, fueled by several factors. The sheer size of the debt, ongoing political instability, and the recent surge in inflation have shaken the belief that US treasuries are the risk-free asset they once were. Foreign governments are hedging their bets. They see the writing on the wall and are slowly, but surely, looking for an exit. This isn't a sudden crash, but a slow, grinding erosion of trust. So what happens if this slow grind accelerates into a full-blown panic? What are the dominoes that fall next? The domino effect. If everyone, or even just a significant portion of foreign investors, decided to stop buying US debt and started selling what they already hold, it would trigger a devastating chain reaction. The first and most immediate consequence would be a surge in interest rates. Right now, the US government has to constantly borrow new money to pay off its old debts. It's like rolling over credit card debt. If your biggest lenders suddenly walk away, you have to offer much higher interest rates to attract new ones. The government is already feeling this pressure. Interest payments on the national debt are projected to exceed $1 trillion in fiscal year 2025. That's more than the entire national defense budget. It's a staggering amount of money, over $2.5 billion every single day, that isn't being spent on healthcare, education, or infrastructure. It's just being sent to bondholders. Over the next decade, interest payments alone are projected to cost every American citizen tens of thousands of dollars. To put this in perspective, the US currently spends around 18% of its tax revenue just on interest payments. For other major G7 nations like France and the UK, that figure is below 10%. Even Greece, a country infamous for its debt crisis, spends a much smaller portion of its revenue on servicing its debt. If a sell-off continues, those interest rates would skyrocket, and that 18% figure would climb relentlessly, strangling the government's ability to fund essential services. The second domino is inflation. Remember, when investors buy US debt, they need to use US dollars to do it. This creates demand for the dollar, keeping its value strong. A strong dollar makes imported goods cheap. But in a massive sell-off, the opposite happens. Foreign investors aren't just selling bonds. They are selling US dollars and converting them back to their own currencies. Suddenly, the market is flooded with dollars nobody wants. Simple supply and demand dictates that the value of the dollar would plummet. This is where the pain hits home for ordinary people. America is heavily reliant on imports. We import a huge portion of our manufactured goods and a significant amount of our food. As the dollar loses value, the cost of all those imports skyrockets. The price of gasoline, groceries, cars, and electronics would all surge. The cheap credit that fueled the American economy for decades would become its greatest vulnerability, leading to a brutal cost of living crisis. As devastating as this would be for America, the final domino would trigger a global catastrophe. For almost a century, the US dollar has been the world's primary reserve currency. This means other countries' central banks hold vast reserves of dollars to back up their own currencies. The logic is simple. If investors lose confidence in, say, the Japanese yen, the Bank of Japan can use its dollar reserves to buy up yen on the open market. This props up the yen's value and prevents a financial crash, but this entire safety net relies on trust in the dollar. If the dollar itself collapses, then those trillions of dollars held in reserve by countries around the world would become effectively worthless. It would be like discovering your home insurance policy was written on scrap paper. It would trigger a wave of currency crises across the globe, leading to a financial meltdown that would make 2008 look like a minor hiccup. While a sudden collapse is unlikely, a gradual erosion of trust is already underway. Countries are actively looking for alternatives. China is aggressively pushing its own currency, the yuan, as a replacement. Others are increasing their holdings of gold or trading in other currencies like the euro, all in an attempt to reduce their reliance on the dollar. We are witnessing, in slow motion, a potential rewiring of the entire global financial system. The impossible choice. So, can this be stopped? Can America pull itself back from the brink? The government is facing two main options, and neither is attractive. The most straightforward solution is to stop the bleeding. Cut government spending, balance the budget, and start paying down the debt. This would restore confidence and reduce the burden of interest payments. The problem? It's politically almost impossible. Politicians win elections by promising to improve services and cut taxes, not by taking away benefits. The vast majority of federal spending isn't on wasteful bureaucracy, it's on three huge items: Social Security, Medicare, Medicaid, and the military. These programs are politically untouchable. Since the 1980s, the US government has only run a budget surplus in 4 separate years. Every other year, it has added to the debt. Initiatives like the recently formed Department of Government Efficiency, or DOGE, have been touted as a way to curb wasteful spending. But even its most ambitious targets would barely make a dent. Saving a few tens of billions is a drop in the ocean when you're paying $1 trillion a year in interest. To truly tackle the debt, brutal cuts to those big-ticket items would be necessary, a move that no mainstream politician is willing to make. This leaves the US with its last, most desperate choice: printing money. The Federal Reserve has the power to create an unlimited supply of dollars. In theory, the government could simply print its way out of the debt crisis. But this would be the equivalent of economic suicide. If America's reputation as a safe haven is already bruised, this would shatter it completely. Investors bought US debt believing it was a rock-solid store of value. If the government starts creating trillions of new dollars out of thin air, that trust would be instantly and irrevocably destroyed. The dollar would lose its value at a terrifying rate. Inflation would transform into hyperinflation. Foreign creditors would dump every last US bond they owned, causing borrowing costs to go supernova. It wouldn't just be a crisis, it would be a full-scale financial collapse, a deliberate rug pull on every country, institution, and individual who ever put their faith in American debt. Strategic meltdown and a glimmer of hope. This crisis isn't just about finance. It exposes a much deeper vulnerability. America's reliance on foreign powers, especially China, goes far beyond borrowing money. It runs deep into the critical supply chains that power our defense, energy, and technology sectors. One of the most critical of these is rare earth minerals. Take tungsten, for example. It's a metal with the highest melting point, making it essential for everything from military-grade ammunition and aerospace technology to electronics and industrial machinery. And here's a shocking fact. There has been no commercial tungsten mining in the United States since 2015. China holds a near monopoly on the global supply and has already shown its willingness to use this as a weapon, imposing export restrictions on critical minerals, including tungsten, in response to trade disputes. This creates a strategic chokehold on global supply chains, leaving the US dangerously exposed. But this vulnerability is also creating a powerful push for change. Major policy shifts are now underway to reduce this reliance on foreign powers and bring critical production back home. The American economy is at a crossroads. For decades, it has enjoyed the exorbitant privilege of having the world's reserve currency, allowing it to borrow and spend on a scale no other country could dream of. But that era may be coming to an end. The path of endlessly rising debt, fueled by politically difficult choices and unprecedented crises, is unsustainable. The warning signs are flashing red. Foreign investors are diversifying, interest costs are exploding, and strategic vulnerabilities are being exposed. The choices ahead are stark: the political pain of austerity or the economic suicide of printing money. Will America find the political will to regain control of its finances, reduce its deficits, and restore global confidence? Or are we witnessing the beginning of the end of the dollar's reign? One thing is for certain: without real, decisive action, this debt crisis will not just be a footnote in history books. It will be a catastrophic event for the American economy, and the consequences could reshape our world in ways we have never seen before. The clock is ticking.